In a moment, I'll give the floor to Albert, who will introduce us to Dr. Eichenbaum's career. But before that, I would like to say a few words about the topic of today's lecture. We can't deny the difficulties for central banks to foster economic growth and prop up inflation in a lower bound environment for interest rates, in particular considering risks to financial stability following a protracted period of excess liquidity. Clearly the case for a more proactive fiscal policy is gaining appeal. First, given the existing downside risks to economic activity, concerns about secular stagnation, and the significant challenges of the impact of climate change and digitalization. Second, in social terms, given the growing concerns about the impact of automation on our societies and the backlash against public institutions as a result of the recent crisis. All the while, considerations over the need for economic stability over the medium term and the importance of well-designed incentive mechanisms for economic authorities must be borne in mind. All in all, there is a scope for a real and serious discussion on fiscal policy design and its limits. There are obvious tensions at play everywhere regarding fiscal policy. For example, in Europe, between the Italian government and the European Commission, or in the US after, for example, the introduction of a reformed corporate taxation system that may lead to worldwide fiscal competition. So today is a privileged opportunity for us to gain further insight into Professor Eichenbaum's views on how to design fiscal policy. So thank you very much, Martin, for being here, and Albert, please.
We're very happy that he could make it. We overlapped at Carnegie Mellon. My first job, he was at Carnegie Mellon. He was already a teacher, a professor there. And it was a great experience. I learned a huge amount from him. I learned a lot of economics. And I also learned a lot of enthusiasm about research from him. So, for example, just to give you an example, I think he gave a talk at LSE on Tuesday, no? Yeah. Then yesterday he gave a talk at Bank of England. This morning he gave a talk at the Cray conference. Now he's giving this. And tomorrow he's giving a talk at Autonoma. No? So anyway. And then I think you're done, no? For the week? Then to Israel. Okay. So there it goes. So I was trying to explain in 2 minutes his thinking of how to explain in 2 minutes his contributions to economics. But I thought to say it this way. In the early mid-80s, when I started doing research, and he was already a few years before me. Actually, we both graduated from Minnesota as well, although we didn't overlap there. So at that time, it was already that the modern models of macro were already kind of dominant. Most research was being done, almost all, but most research was being done with equilibrium models, rational expectations, micro foundations. And at that time, there was a very big emphasis on theory, on many papers showing that rational expectations was important and that you shouldn't do ISLM, and there was a lot of theory and a lot of methodological contributions. And I think Marty was one of the first to start saying, well, yeah, that's all very good, but unless we find a way of using these models to say something about policy and about them, and to understand the data, these are not going to be worth for anything. And from the very beginning, he was one pushing everyone, and in his papers, he was always bringing these models to the data and using them. And this slowly came together, putting together a few pieces from VARs and a few pieces from models and a few pieces from how to compute models. In the end, he was one of the main actors that made it possible that in the first decade of the 2000s, many central banks used these equilibrium models, and people thought in central banks as an ingredient, at least an ingredient for policy, to have these equilibrium models. The most influential paper of his in this would be his joint paper with Larry Cristiano and Charlie Evans. And one can always criticize if these models worked or didn't work, but we wouldn't have known if they work or not if they had not been built, first of all. No? So I think this has been a very huge contribution. Nowadays, we wouldn't think of macro models as pure toys. No, this idea that we have to bring them to the data and use them for policy is kind of taken for granted. I think another big contribution that he made was he went to Northwestern. Actually, he left Carnegie very briefly after I got there. He went to Northwestern. When at Northwestern there wasn't a lot of macro, let's put it that way, and he went there, and now Northwestern is one of the very best places in macro in the world. And actually, just to mention, one of those very best is Guido Lorenzoni, who did a master at Pompeu Fabra, and another is Martí Mestieri, who did a master at Autonoma. So we have some influences there. He's also been an AR editor, and he also had a huge impact. And to emphasize again, I would think of Marty as a true academic, no? Someone who I was giving the example of all the talks he's giving, which obviously he doesn't need to give to have his work read, but he's still giving them and coming here. And I remember, for example, him saying that he had a great time being an AR editor because he had learned so much because he could see the discussions of actually read them. So anyway, I'll leave you with him. He's talking about how things change with fiscal policy when interest rates are so low as they are, and looking forward to your talk.
It's really it's a pleasure to be here. Always to see old friends and make new friends. But today is really a policy, I hope more of a policy talk, I think one symbol in the talk, so I think that's good. So I want to talk about the new normal, because the question is, what is the new world that we're going into? And so I want to start from the premise, I mean, I'll try and argue why, that we should think of slow growth and low real interest rates as being normal. That's the world that we're going to live in for, as far as my eye can tell. And I will argue that low interest rates means that monetary policy will simply be less effective in combating severe recessions. Now that's not a view that everyone shares, including some very distinguished members of this audience, but it's a view that I'll take today. And I'm going to argue that we need a new, and I want to emphasize practical framework for using fiscal policy to fight severe recessions. And so this discussion is arranged around a proposal that I actually made at a recent G7 meeting that I've been a proponent of. So let's start off with what the world looked like in 2005. And so this is one more example of where green is good. And so this is a heat map, so to speak, of what growth rates look like around the world in 2005. And you can see things like China, of course, very dark green in this context, meaning very high growth. And you can see Russia, believe it or not, very high growth, parts of Africa, that's good news, and the United States and Canada, and I am somewhat Eurocentric in these views, certainly healthy shade of green. One thing to remember about the United States is that it never grows, in the past, didn't grow particularly fast ever, and never particularly slow. It's like a turtle. And if you take 1.03 to a very big power, you become rich. Bob Lucas once famously said that if you're growing really fast or really slow, that's both really bad news, right? Because if you're going too fast, it's going to stop, right? Those are the kind of economies where that happens. China may be a counterexample. Now, of course, we all know to our dismay, if you look at that heat map in 2009, it's certainly not a dark green. And in fact, there's lots of dark, I guess blue it is, where we have less than 0%, so, you know, contractions. And the severity of the recession obviously depended on where you were. Now, let me just look at this from a US-centric point of view, but I don't think the story would be any different. I know the story would not be any different in other countries. And this is a complicated graph, which I'm going to return to. But what I'd just like you to see here is what I have on the horizontal axis are, you know, looking at particular periods that are recovery periods. And the dark green tube is what was the growth rate during the business expansion. Okay, and so what you see was from 82 to 90, just ridiculous, you know, real GDP growth of 4.2%. Then 91 to 2001, it's kind of 3.6%. 2001 to 2007, 2 points, you know, and then this was, and graph happens then in 2009 to 16, and believe it or not, the recession officially ended in 2009 in the United States. It comes down to 2.1%, right? So there's this, I don't know if you would call it secular, but certainly since the 80s, the expansions after the recessions have been less robust. Now, fast forwarding to, roughly speaking, where we are now, what you see is this doesn't look at all like that wonderful graph I showed you before the Great Recession, right? There's still lots of god-awful dark blues. In the United States, we'll come and look at precisely those numbers, but also Europe. You see some spots of happiness like China, but you just see lots of dismal growth around the globe. So, you know, we're past the Great Recession a long time, and yet we have these low growth rates. So the obvious question is, why was the recovery so weak? Well, there's an optimistic view. What's the optimistic view? Well, consumers entered the crisis with high leverage rates, which they're slowly winding down. You could argue, although Jordy would disagree, that monetary policy was not very effective at the zero lower bound. You could argue that there was enormous uncertainty about government policy that led to low investment levels. I myself am skeptical about that, although I think in certain sectors it's obviously true. And probably, and this certainly makes sense initially, that uncertainty about future demand here and abroad has led to extremely low investment levels. For what it's worth, when they do surveys, or they did surveys a year or two after the Great Recession, tight credit always came in dead last, except for the very smallest firms. That's not what firms say they were investing. They typically, the number one answer was, we're not sure we can sell what we produce, right? That's not a very sexy thing in terms of lots of modern researchers, but I actually think there's a lot of truth to it. This is very, very old-fashioned Keynesian notion. So that's the optimistic view, because all of those things fundamentally you think will turn around. But there's a pessimistic view, which says everything I just said, and, very important difference, that what we're going through in the major economies is a very persistent decline in the underlying growth rates, in the secular growth rates. Now, sometimes people call that secular stagnation, and that means a different thing to different people. It's partly a marketing tool, it's partly to get your attention. But fundamentally, what it means is that we will have a very persistent lower growth rate for the far future. And it comes about, and I'll emphasize two things, one of which is just obviously true. We'll come back to what, if anything, you could do about it, declining population growth rates. I'll show you some data, but I mean, certainly people in Europe are familiar with that phenomenon. What I will argue, it looks like persistent declining growth rates of productivity, and perhaps declining investment levels, at least in physical capital, relative to very high savings rates. And each of those contributes to a secular, so-called secular stagnation. Now, is this just sort of me making this up? Well, no. I mean, we can look at various estimates of real GDP growth, and this happens to be a pretty recent one. What I want to direct your eye to is not the Q1, Q2, but look at 2021, right? So that's macro advisors, but that's only one of many places. If you look at the March FOMC number, so that's from the Board of Governors, they estimate essentially the permanent growth rate of the United States to be 1.8%. So remember, I used to talk about that 3%, the 1.03 to the big number. That's now 1.0. And when I talk about this with MBAs, I get them to bring out their Excel things, and everybody has to enter 1.03 to the 50, and then they see a number, and then I put 1.018 to the same exponent, and they gasp, right? So as you all know, the most powerful force in the universe is the power of exponentiation. That's Keynes's line. It's also totally consistent with the IMF, right? So if you look at the IMF, and these numbers bounce around a little bit, so you never want to take them too seriously, but if you look at the United States, we grew at about 2.6% from 99 to 2008. The IMF, depending on exactly which version of the wheel you look at, has us at 1.4% on a long-term basis. The euro area, not very different. 2.1 wasn't great to begin with, but it's now down to roughly 1.4 in terms of estimates. Japan, of course, is a catastrophe. Russia, for a lot of reasons, is a catastrophe. China is all the way down to 5.6%, right? That's a steep decline, and that's a good scenario if everything works out. India is the one bright spot, and I don't know Spain, I apologize for that, but I imagine it looks like the rest of the euro area. So you want to note this low long-term forecast. Now, of course, the fact that all the so-called experts agree, and they probably agreed once that the Earth was flat, so we don't want to take that as a sufficient condition for being true. But certainly, as far as we can tell, it does not look good. So the question is why? And I don't want to be very technical here, I mean, it's not the right forum, but as a mechanical device, we can think of the percentage change in output to a first order is going to be due to the percentage change in the labor force, right? Just what do we think our labor force is going to look like, times the percentage change in labor productivity, right? So to a first order, that's sort of going to tell you, organize in your mind what's going on. How does the labor force grow? Well, it grows because of the growth rate of the population, and it grows because of changes in the labor force participation rate. So those are the two key factors. The growth in labor force, in labor productivity, lots of reasons, capital per worker, quality of the labor force, but there's the ever mysterious rate of technological change, right? So those are the organizing devices. Well, let's start with the United States, and we know that the population growth rate is falling. So what I have here is just the raw growth rate, and there's clearly a long decline in the United States from 1.7% to something maybe 0.6%. And of course that declining population growth rate means a decline in the growth rate of the labor force and in employment, right? So that in and of itself is a very powerful and demonstrably true negative force on the growth rate. But of course, in the US actually, it's worth just looking aside here, there's an enormous and incredible difference between the growth rate and labor force of participation between men and women. So for a long time, women were saving us as they poured into the labor force in the United States, but that's stabilized, right? So we just don't see further big increases in labor force participation rates in the United States. The men, quite frankly, it's quite a mystery. We don't know what they're doing. I mean, we know they're not doing housework, right, for a lot of reasons, including surveys. But we don't know how they're taking care of themselves. It's an enormous mystery. It actually turns out to be primarily white males. How are they living? Well, so I'll just leave it as a question. We actually don't know. Okay, what is true is mobility amongst those people, that class of society, has really gone down. Manufacturing has been declining for a long time in the United States, right? It's not a new thing. In the old days, people, when they lost that manufacturing job, would move somewhere else. Now they're not moving. We don't know what they're doing. Okay, it's a huge mystery. Now, of course, it's not just the United States phenomenon. That's very important. Even though I'm American-centric, it's very important. The one thing that we're pretty good at predicting, right, as economists, is population growth rates. They're not exclusively determined by income, but they're very heavily determined by income. So if you look at this graph, what you see, the green are the more developed regions, and you see in the 50s, 1% roughly is population growth, and it's basically coming down to about 0, right? That's what that graph is showing you, or it's at least projected to go there. You see the middle graph, which is the less developed regions, and they're following this inevitable law that as people get richer, they tend to have less children. And the economist to me says that's easy, the opportunity cost of having a child. If you're richer, if women are more educated, etc., clearly the opportunity cost goes up, and women and their husbands respond to that incentive. And even in the least developed regions, right, you're also seeing a decline as they are projected to grow over time in terms of income. So Europe is a leading example. There's obviously variance across countries. So labor markets, how they're organized, matter, right? If a woman exits the labor force to have kids and can't come back, that's a huge problem. If she has daycare facilities, et cetera, especially if it's tied to labor force participation, it matters. So if you try and explain labor force participation across Europe, you do find variation, but there's this fundamental force at work. Fundamental force at work. Now going back to the US, this is from the Congressional Budget Office and quite recent. And what, again, you can see here is if we look at this growth rate of real and potential US GDP, you can see here that, of course, during the crisis, the black line says we were way below potential. But what's happened is that the growth rates of our best estimates of potential GDP are coming down. It's not that we're going anywhere back to that post-99, say 99 period. So there is this slowdown in potential US GDP. So we can decompose, or we can try, we could do the best that we can, what quantitatively are the growth rate of potential US GDP. So if you look at 1950 to 73, you can see the orange is a lot of it is the growth rate, the growth of the potential labor force is the black, and that's just coming down. We just spoke about that, right? So if you go from 1.6% to 0.4%, that in and of itself is hurting. But it's also right, and this is the orange part, and that's the growth rate of potential labor force productivity, okay? You also see numbers that are coming down. There are exceptions, 74 to 81 was terrible, but there is this view that the growth of potential labor force productivity has come down over time. And that's really bad news. Now, it's kind of funny when I give this to executives, especially executives in financial industry, or talk about this issue. Let me start with Robert Solow and come back to the executives in a minute. In the late 80s, Robert Solow famously said, you can see the computer age everywhere, but in the productivity statistics. That's what people were claiming then. And now, especially when you speak to people, you say, oh, I see it everywhere. I see it in smartphones. I see it in the Internet of Things. My vacuum cleaner can now talk to me. So it seems everywhere, but not in the productivity numbers. So what actually happened in the original Solow paradox, the way it was resolved is, yes, you had certain sectors of the economy, like semiconductors, computer manufacturing, they grew rapidly. And eventually, they spread to sectors like retail, who started to use some of that technology and put in productivity-enhancing innovations. So you have to have in mind that it starts somewhere and has to go somewhere. And when it went somewhere, we did have a period of rapid productivity growth between 95 and 2004. But what was absolutely crucial was these leading industries, these technologies, somehow spread out to the larger sectors of the economy. And it's not obvious, but I hope it will happen. We talk about the internet seems old hat to me, but 5G, AI, everybody says that's so cool, and they have an anecdotal story about it. But when is it really going to make a difference in the large, low productivity sectors of the economy, where most of the action is? AI, will that help us sell tomatoes? Will that help me teach students? It might. I mean, universities are probably the worst place to look for productivity growth. But that's another thing. And it's even worse than you might think, because of course, as technology expands, it pushes people in many ways out of the leading sectors and into the non-leading sectors, right? So just that force alone slows down, somehow those people have to be absorbed. And if you do various mechanical accounting, that force in and of itself, maybe accounted for 0.2, 0.3 of a decline in productivity growth. Just that force. You've got to get the people from the high productivity sectors into the low productivity sectors. So the bottom line is that small, highly productive sectors really can't drive the aggregate growth rate of productivity. They really can't, at least until they spread. And I mentioned I was going to Israel at the end of this trip. That's a great example. Everybody thinks about Israel as this high-tech nation, right, where they're developing all these amazing applications and amazing high-tech stuff that gets you, wherever. If you look at productivity levels in Israel relative to the OECD, they're in the bottom third. They're in the bottom third. So yes, there's 3 really fancy guys designing apps, and then there's a lot of very inefficient retail, construction, all that other stuff, which never makes the newspapers. So the trick is, how do you get from that small sector to the larger economy? So the first thing, to come to ultimately to fiscal and then monetary. So, what do we do to increase the growth rate of real GDP? Well, I'll say the obvious things. Smart tax reform, which is not what we had in the United States. We had a tax cut, we didn't have tax reform. Obviously, cheap things like lower regulatory burdens. I'm not saying this because I'm politically correct, but I believe it. Immigration-friendly policies to get the best and the brightest from abroad. As a Canadian, I can tell you, here's our strategy. We're going to steal everybody that has a hard visa getting to the United States. That's the plan. Okay? And if you look at the place that's created the most high-tech jobs certainly in North America, it's Toronto, not San Francisco. Right? And it's not by accident. It was very much through incentives, et cetera, fiscal policy, and immigration policy. Again, these are all obvious things, and I really don't want to belabor the obvious. I do want to talk about labor force participation rates amongst men and women. That's really important, right? Getting those white men to work and stop doing whatever it is they're doing. But critically, getting female labor force participation rate up is absolutely crucial. And that there are obvious things that can be said there that are really the focus of another seminar, but I think that's important. Here's the problem. Everything I said there is in the short run expensive, right? Costs money. And the US, and certainly many parts of Europe, are already running massive deficits. Here it is. Here's what government debt to GDP ratios was in 2005, believe it or not, right? And you can all look at Europe, and 25 to 50% is what we used to be talking about, and that was a terrible thing when you got to 50, right? And the debt police would come knocking at your door, in principle. And now you go to now, and it's over 100%. Certainly, in the United States, it's incredibly high. Canada's actually relatively in good shape. Russia, interestingly, is in pretty good shape. That may be that if you're cut off from financial markets, you can't incur much debt, right? So that's not all fiscal. Venezuela looks good on that dimension, too. But there's no doubt that debt to GDP ratios have gone up enormously, right? There is a little bit of good news, though, in terms of those social investments, which is real interest rates are really low. So, if you think about the real interest rate on a 10-year government bonds, they're arguably under they're really low in the United States. They're probably negative in a bunch of Europe. So the question is, the challenge is, can you think of a social investment that has a risk-adjusted rate of return on the investment of higher than 0.8%? If the answer is yes, why aren't you doing it? Right? You can borrow really cheaply. That's the bottom line. And if you can come up with those investments that somehow magically turn up into higher productivity, Or, I mean, just higher productivity, if you got it to bump it up by 0.5 percentage point, then the deficit would drop, to 3.7% of GDP in the United States instead of 4.4%. But I can make exactly the analogous arguments in a European context, right? Interest rates are cheap. People are dying to lend you money, right? The idea that bond markets are panicked about debt in Europe is simply wrong, right? And they may be wrong, but they're willing to give you money really cheap. I think that's just an undeniable fact. So now we come to monetary policy, and the bad news is, of course, that low interest rates are really a big problem for monetary policy. So by next month, the current expansion will have lasted about 121 months in the United States, so that will make it the longest period between recessions in US history. Now, I don't think recessions have memory, so I think people who tell you that because we haven't had a recession, it's, God is getting angry and he or she is going to give us another one. But I'm pretty sure that there will be another recession. Don't ask me for a date but I'm pretty sure we're going to get one. It's not at all clear, and I say here the Fed, but I could put the European Central Bank, will be in a position to effectively fight it. The problem is, again, subject to our discussions we can have, the Fed, the ECB, can't lower interest rates much below zero. You can do a little bit, but there's some argument about just how far down you can go. Monetary policy is actually pretty easy in normal times. So it's actually embarrassingly easy, right, for those of you who aren't monetary policy experts. The Fed or the ECB targets some policy rate that the banks charge and lend to each other when they borrow and lend. And if somehow the Fed or the ECB can affect those cost of funds, they're going to affect all short-term interest rates because these things are highly substitutable. And then if they have persistent changes in short-term rates, that's going to land up affecting long-term rates, not surprisingly, and we have pretty good estimates of that pass-through. And there's a simple expectation hypothesis that, which is not a perfect theory of long-term rates, but essentially the idea is we have these persistent change in short-term rates which channel into the long-term rates, which is what really matter. And fundamentally, the Fed has some notion that, first of all, it has and the ECB, they have some long-run target level of inflation. I don't know where it came from, but it's 2%. There's no theorem that tells you 2% is magic, but that's what it is. And the other thing that the Fed and the ECB and the Bank of Japan and all these people, well, Japan's dangerous because Japan is a counterexample to everything, or whatever you say, it's not true about Japan. But over very long periods of time, the notion is that real interest rates, that's not what the Fed or the ECB affect, right? And I'm going to call that R star, and that's set by the market. All the fundamentals that we teach students about the growth model or some other model, an OG model, that's what R star is. So if you want to know what the long-term, short-term interest rate is, add R star and the target inflation rate. Right? So that's it. What do monetary policy people do in normal times, although it's shrouded in mystery and they make it look really hard? They look at inflation, and if it's higher than 2%, they raise rates. How much exactly? Well, that's what maybe they need my model for, or Jordy's model, or some variant of that. And they slow the economy down. Wages fall, marginal cost falls, and then the interest rate, and then inflation falls. If we're in a recession, though, what do? They lower the policy rate to be less than 2%. So they lower interest rates aggressively, and through a variety of mechanisms. Albert was very gentle in talking about my prototype models. We had one mechanism, Larry Cristiano and Charlie and I, which was a very stylized representation of they make it cheaper for consumers to borrow, and so they intertemporally substitute. Maybe that's true, but just think about housing policy, mortgage rates, other mechanisms that spur spending when you lower interest rates. Okay? But they're basically going to goose, as we say, aggregate demand when there's slack in the economy and things pick up. Okay, so this is an example in the United States. What is the red line? The red line is a simple mathematical version of what I just said in words, the so-called Taylor rule. And we don't have to go into the coefficients because of lack of time. And what you see here is, yeah, the Taylor rule is, tells you what the red line is what the Fed actually did. So you're comparing the black line and the red line, right? And they kind of look, until the Great Recession, like they're tracking each other pretty well. Now, there's some distance between them in various periods, and that caused lots of fights and lots of PhD theses, right? Should the Fed have been tighter in 2004? There's room for disagreement. But fundamentally, this is getting the basic idea. Now, of course, and this is precluding something, what is going on with the red line versus the dark line? If the only weapon you had was traditional monetary policy, the Taylor rule says you really should have reduced nominal rates a lot more, at the worst point of it by 6 percentage points, than they actually could. Right? So it's going to turn out that there are other things that they could do that helped, but based on the Taylor rule, it looked like, oh my goodness, this zero lower bound was incredibly, incredibly binding, both in Europe and in the United States. Now, let's tie these two parts of the talk together. Most people thought the natural rate, that R star, was around 2% before the Great Recession. It's a coincidence, the 2% and the target inflation, that's a coincidence. I tried to convince you we have this terrible fall in productivity and population growth rates that have pushed down the natural real interest rate. And we can make the story fancier by bringing in global savings, lots of things of that nature. Now, people have tried to estimate that R star. And what you see here, this is from the blue chip. It's one particular set of estimates, and you can see these folks think that it's somewhere under 1% now. There's a big standard error, which John Williams in a recent speech has talked about. We have a lot of uncertainty, but the point estimate coming out of here is that that R star has gone down. If you look at other estimates of Williams, you can argue that it's even lower than this particular estimate. Maybe it's 0.5%. So R star fell, but the inflation target of 2% hasn't changed so far. So you shouldn't be surprised to see that in the US, estimates of the normal policy rate, they used to be about 4.5%, and they're now roughly 2.75% and continuing to fall, right? So that's just sort of all consistent with the decline in R star and the insistence on a 2% inflation rate. And the interesting chart here is to look at market pricing for year-end federal funds rate. There's no view that interest rates are going back to where they used to be. If anything, we're thinking of 2%, maybe 2.5%. I know in my bank job, another story, right? We were all very excited about raising rates. That's a separate story. Why would a bank want rising rates? Let's leave that for later. But we're now really worried about falling rates, right? We just think that's going to give us a hit. And it's obviously not just the United States, right? So if you look at expected overnight interest rates, it's worse in Europe, right? That's the euro area is the green, which is just catastrophic. The United States, for comparison, is the blue, although they're coming down. And of course, just alluding to what I talked about before, if you look at 10-year government bond yields, in Europe, in Germany, for example, they're just astoundingly low. And on average in the euro area, they're, as I said, around 1%, maybe a little bit lower. So that's incredible. And the US, they're, higher somewhat. So why should you care? You get a mortgage cheaper, why does anybody care about this? Well, the fact is, in the 8 recessions from 57 on, the Fed, in a typical recession, dropped the federal funds rate by about 500 basis points. That's 5 percentage points. But if you start at 2.5 to 3%, never mind what the Europeans are starting at, you're just going to run out of room. And you won't be able to do normal monetary policy. Maybe there are other things which we'll talk about in a minute that you could do, but you can't do the normal thing. How often is that zero lower bound going to bind? Right? How often are we going to hit that, call it a speed bump? There are various back-of-the-envelope calculations you can do. I put them in the slides. My own back of the envelope estimate says about 30% of the time. Right? I won't drag you through the math on that. If you look at the most sophisticated estimates by people, by Michael Kiley and people at the Board of Governors, they have higher numbers. They have over 40% of the time. So it's going to be higher. Right now, this is not rocket science, so standard errors there, but it seems reasonable, all things considered, that the normal stuff that we do will not be able to get away with. Okay, what about unconventional monetary policy? There's no question that, in the United States, we focused on buying long-term treasuries and mortgages. That will help. I have no doubt that it contributed in a positive way. But, we really shouldn't be sanguine about just how powerful those policies are going to be. So in the U.S., suppose we start at 10.5% 10-year rates. And suppose policymakers get the real rate, the 10-year annualized rate, to 1.5. Then the ZLB is binding. Well, the question is, how much extra stimulus do you think you can get from unconventional monetary policy that pushes long rates a little bit lower than 1.5%? You're going to get some. Right? I think we can agree, but it's hard to imagine that's going to solve the problem. And you guys are in worse shape, right? Because roughly speaking, you're starting at 1%, not at 2.5%. Let me just say, because there are time constraints, there are lots of fancy strategies being entertained by central banks. Things like forward guidance, like promising to keep interest rates low really long after out of the ZLB. I don't believe it for a minute. And I don't think markets believe it for a minute. Because they didn't deliver it this time, so why should they deliver it next time? I mean, no one actually thinks they've really delivered on forward guidance. There are things like fancy strategies like price level targeting, which amount to forward guidance. That's really the mechanism they're amounting to. And I didn't believe it before, I don't believe it now, and I don't think if you're really a price level targeter, you're going to have to do recession sometimes to get back to price level target. That's not time consistent, and the politicians, I don't believe, will let us get away with it. So I'm not looking for savior there. What about changing the inflation target, right? I mean, here's what we can do. We can just say, oh, we're willing to go with 4%. Two problems with that. It's like increasing your insurance premium every day in anticipation of the accident. Might be okay. I don't know how we got inflation expectations anchored at 2%. I have no idea what would happen if we said all bets are off, we're going to 4. Right now we're into the realm of psychology. And we're awfully bad at communication at central banks. So how are we going to communicate that? What's that transition going to look like? So I'm deeply skeptical about raising inflation targets, even though mechanically, if you could really credibly do it, etc., you might want to try. So we now get to fiscal policy, finally. The conventional wisdom is, fiscal policy just doesn't work very well in normal recessions. Why? Well, there's the political. It's really hard to design and implement wise discretionary fiscal policy in the middle of a crisis. You're in panic mode. It's just really hard to do. The political economy is, once you give people stuff, it's really hard to take it away. Franklin Roosevelt introduced subsidies for beekeepers in the Great Depression. We still have them. That's true. And there's economic considerations. If you actually look at the multiplier and ask how big are they for most items, there's a lot of uncertainty about these things. But if you look at the best guess of the IMF or the midpoint of estimates in literature, it's about 0.5. The magic story, the multiplier in our textbooks, in Econ 101, it's not this huge number that you might anticipate from your textbooks. Why is the normal multiplier small? Well, it's partly because of monetary policy. If you have expansionary fiscal policy, there's two forces working against you. Typically, you're borrowing, and that puts upward pressure on real rates. But maybe even more important, if it works, you're expanding employment, marginal costs are going up, you would expect to see an uptick in inflation, and the Fed, or the ECB, doesn't like that. That goes back to our Taylor rule. So yes, you're expansionary to some extent, but then the Fed will raise real rates, and that's going to crowd out, so to speak, consumption and investment, So yes, G goes up, but C and I potentially go down, and those are powerful countervailing forces. So the multiplier, as I say, it's not 0, but it's not much bigger than 1, I don't think, in normal times. What if the 0 lower bound is binding? Well, then we just don't think that government borrowing is going to put much pressure on real rates in deep recession. But even more importantly, if you think about the real interest rate, and this is the only equation here, it's the nominal interest rate minus expected inflation. So now imagine the nominal interest rate is stuck at 0. And imagine that I'm a government or manages to increase economic activity, putting positive pressure on inflation. Well, I got a negative on there. So now in this bizarre world of the ZLB, real rates are going down. So just the opposite of what happens in normal times. And if real rates are going down, consumption's going up through a variety of mechanisms, and investment's going up. But if that's going up, marginal costs are going up. So we have this virtuous cycle. Just how big that is, no one really knows, but we're not going to have those mechanisms fundamentally that are crowding out C&I, they're crowding them in. So the takeaway is fiscal policy is probably not so powerful in normal times, but it's really powerful potentially in really bad times. So what happened in the United States, and it's just worse in Europe, right? So if you look at the United States, Jason Furman, who was head of the CEO at the time, calls it political fiscal fatigue. We just got tired. We prematurely withdrew stimulus during the Great Recession. Just think about unemployment benefits, something very concrete. Congress, as they often do, passed extended unemployment benefits, both levels and duration, in June 2008. Remember, at the time, unemployment was 5.3%, and the long-term unemployment rate was 1%. 10%, that's a typo, it was 10%. Congress allowed those higher benefits to expire at the end of 2013. Oh, I'm sorry, when short-term was regular unemployment was 5.3, long-term was 1.0. So now fast forward to 2013, Congress got rid of that stuff when the regular unemployment rate was higher than the number that it was when they introduced the program to begin with, as was long-term unemployment. So if the first decision was right, surely the second was wrong, and almost certainly the first decision was right and the second was wrong. The other thing, and this is crucial, this is very American, the states operate subject to a budget balance, right? They're operating deficits. So if their tax revenues are falling, they have to cut spending. If you look at government spending at the state and local level, it actually contracted after 2011. I'll show you a picture of that, which was exactly the wrong thing. We had fiscal contraction, not fiscal expansion. So the federal government spending and taxes and benefits contributed negatively to real GDP growth from 2011 on. And this is a great picture. We can't go into much detail, but this comes from the Hutchins Institute on Fiscal Policy. And this is a complicated bar graph, but when it's positive, fiscal policy in different forms is contributing to positive growth. When it's negative, it's contractionary and doing the wrong thing. And they break it up into federal spending on goods and services, state and local taxes, and taxes and benefit programs. What you want to see here is around 2011, they do exactly the wrong thing. So the Obama program comes in, they're doing the right thing. By 2011, they're doing the wrong thing for a really long time. And it is not a coincidence that we had an abortive recovery at exactly that time. So let's think about an alternative strategy. So I'm going to go through a couple things which will strike you as a mad academic, and then I'll try and convince you that they're not so crazy. Because I think they apply, all this logic, of course, applies to Europe as well. So one thing as I talk about, and I want to emphasize each part of it, asymmetric automatic stabilizers. So the idea is we have changes in automatic stabilizer programs that kick in, and just as importantly, kick out automatically when we clearly articulated, easy to measure, and simple to communicate macro variables hit pre-specified targets. As an economist, what would my preference be? you would make that target variable the short-term policy rate. When the ZLB hits 0, these things kick in. When they go back to some number that you think is normal, they kick out. Now, that's important, the kicking out. I'll come back to that. One example, going back to this unemployment example, but it's just one, would be more generous, both size and duration of unemployment benefits. Right? You just do that. Now, why automatic? Right? Why would you do this automatically? So let me talk about automatic and then asymmetric. Automatic is useful because these stabilizers, I'll argue, start quickly when they have the most effect, and they end when they're not needed. Right? Once you're back out of the ZLB, these things are not very powerful. So first, I think they're policies that you design outside of a crisis are much more likely to be thought out carefully and better communicated than discretionary acts that are designed in the middle of a crazy crisis. And critically, if you put them in law, if you think about individuals, they may get expanded unemployment benefits. And they usually do get some, but then they get taken away. So if you're a person who's worried about potentially being unemployed, what's a wise strategy? The world is going to hell. Maybe I should increase my savings, right? Just in case. What's the worst thing you can do in a crisis when the ZLB is binding is increase your precautionary savings. So the social costs of that uncertainty are potentially enormous. So if those automatic stabilizer programs were embedded in law, we could easily imagine people saying, the government's got my back. So yes, I may increase precautionary savings, but not as much as I would have if I wasn't sure that by law I'm entitled to these benefits. That very fact would make the recession less severe, and probably you'd have to pay out less in unemployment benefits to begin with. Right? So I think that's a huge advantage. Okay. Why asymmetric? Well, a lot of automatic stabilizer programs actually have limited benefits during normal times and many important negative benefits. Let's talk about unemployment insurance. On the positive side, it's certainly true that in a normal recession, right, you reduce precautionary savings a little bit, and you certainly raise the income of people who almost surely have a high marginal propensity to consume. But the fact is that the aggregate impact of those effects is pretty small in normal recessions. There's relatively few people that are unemployed in normal times, and very few that are unemployed for a long time. So yes, you'd certainly have some benefit, but the multiplier is likely to be much smaller than in in the ZLB times. Whoops. And there are really negative effects, right? We know, or we think we know, that higher unemployment benefits raises workers' outside options. It leads to higher wages and a fall in job vacancies posted by firms. So theory and a lot of empirical evidence suggests that very high unemployment benefits, even if they're not paid, tends to lower the average level of employment. Okay? So, and I won't go through the logic again, they're not going to be very powerful in normal times on the plus side, and you have to live with all the negative things. So those are real problems. But of course, for all the reasons I just talked about with government spending, when the ZLB hits, that's exactly when you think those aggregate demand effects are very powerful, the precautionary effects are very powerful, and it's not, you know, those things, and Matthias Trabant and Larry Cristiano, I actually formalize that in an econometric article, but the bottom, I think the intuition is quite straightforward. Now the fact is, you don't have to stop with automatic stabilizers, right? You could engage in what Emmanuel Fari and Pedro Tellez and others have called unconventional fiscal policy. We talk about unconventional monetary policy, why not unconventional fiscal policy? There's nothing that prevents us from writing into law macro triggers for temporary tax cuts and triggers for ending those cuts, right? Nothing at all. Tax schedules would automatically change in extreme circumstances when the ZL becomes binding and revert to old levels when a crisis is over. The basic insight of Farhi and Tellis and co-authors is, for those of you that are into these models, a cut in sales taxes on consumption looks identical in terms of consumers' decision problems as a cut in the interest rate. There's no difference. And so they argue, at least in a variety of models, you can get to the first best. You completely make this ZLB problem irrelevant. Okay? Just want to check one thing here. You can do this with investment tax schedules. You can do this with income tax schedules. And I would argue in a European context where you really do need credible commitments not to have permanent, once you do it and then you can't take it away. If you could write these things into law, and there's no reason why you can't, you might even be able to get the Germans to agree or not grumble, right? Because these are not open-ended promises. Now, is this crazy, right? Is this just a crazy thing? I don't think so. Marty Feldstein, God knows is not a wild academic, suggested precisely this for Japan. He said temporarily suspend the VAT and commit to raising it 2 years later. Notice he made it a time contingent policy. I'm suggesting that it ought to be state contingent. So there's a difference between those two things. It's also, we do this behind temporary tax credits to boost private investment. We do this all the time. But we do it in a way that people can't count on. We do it in a last minute, so there's no reason to think it's well designed. And there's no reason we have to stick to that idea. Now, as a practical matter, should you tie it to short-term interest rates? That's dicey, right? Because just imagine you're the central banker who has to pull the final trigger, right? That's a lot of responsibility to put on his or her head, okay? So it may very well be that what we want to do this is tie this to, quote, more objective aggregates. It won't be as good on economic grounds because most of those aggregates are more slower moving, right? But it may be as a political reality. It's certainly better than doing nothing and gives the central bank the plausible deniability about fiscal policy that it needs. But again, I want to emphasize, I don't see why we can't do this, certainly not on stabilizers. So, let me just conclude. I think I'm overusing my time. I really do believe the new normal is slower growth, and we're going to have lower interest rates. Monetary policy, subject to various debates in the literature about this, it's hard for me to believe will be as effective completely as it was in the past. I think there are a lot of things the policymakers did on the monetary policy side that was great. I remain skeptical that those new strategies will be perfect substitutes. So I think that we have to revisit the challenge of fiscal policy. As an American, I can tell you that the political costs of the Great Recession were enormous. I won't get into my politics, but you can guess. I imagine the same is true in Europe. And so I think unless we think creatively about alternatives, we're potentially going to have much larger problems because of populism than any problems of a temporary increase in the debt from 60% to 70%, where we promise by law that we're going to reverse those temporary benefits.
Thanks, Martin. So we start the question and answer. I don't know how.
I'm happy to take
long...
questions or debates or.
Well, you have to. Yeah.
How long? Whatever you want. I think I was a little over my limit.
You are?
I don't know. I think about that.
Depending on the...
Yeah, no? Mm-hmm. So,
does everybody
questions? Anyone raise your hand? You want to ask?
I have a question and a comment. What happened when your unconventional fiscal policy, say a constitutional change, happened from one day to the next, but in the opposite direction? In Spain, we had a constitutional change that took place to, to stop a fiscal expansion to go too much into the debt. So it could happen that what you get is try the opposite, like what we did. It was a very fast constitutional amendment that took, what was that, 1 month or less than 1 month, suggested by the Germans. So you can have the opposite effect, and the credibility of those rules is under, you say, the credibility of monetary policy of getting the level of 2% is zero. So anything that they can claim forward guidance doesn't matter. I think you could find the same problem in fiscal policy if you try to do that. And the other thing is, you were quite pessimistic in the view on productivity. Don't you think that most of what is happening is just a measurement problem? Because that's what we had in the 80s. I mean, the solution in the 90s was to change the way in which we were counting the prices of semiconductors. So it was a measurement problem, basically.
So, let me talk about each of those. Let me start with the measurement problem, because every time I give this talk, someone from the banking industry goes, "Oh, but we have a new app." Right? Isn't that great? And how's that counted in your statistics? And then I say, how many tellers did you fire? And how many people in cybersecurity did you hire? And how many people in anti-money laundering did you hire? So it's possible there's measurement here. I have no doubt. All I can say is that the best people like John Fernald and others have estimated that might account at best for about a third of this. A lot of uncertainty. But when people tell you about Netflix, right, they go, "Oh, I have Netflix." And they go, "Don't you pay a subscription? That's in GDP." And they go, "What about Google?" Well, Google, that's maybe raises your level of welfare. I have no doubt about it, right? So there is measurement there. It's impossible to deny. The best that we can tell, it's about a third of it. On the politics, I mean, European politics are very complicated. There is no magic solution, right? I mean, you can never tie yourself with perfect credibility as you go down. The question is, can you move in that direction? Can you not, I would say, let's not let the perfect be the enemy of the good.
Jordi?
Could I ask you to show again the Taylor rule graph?
We expected this.
The orange.
There we go.
Yeah.
There we go.
Now, you made a statement which I thought was interesting and pretty strong during the talk, after you had shown this, several slides later. You said, well, the Federal Reserve, on forward guidance, the Federal Reserve, forward guidance is no longer credible. It will be useless next time, because this time the Federal Reserve didn't deliver, so they won't fool us. They won't fool us again. Now I look at this picture, and I see some evidence of forward guidance being delivered. No, or how would you interpret this gap?
So I think this is an interesting point. This is a really interesting point. People, so for example, we are under, up until recently, the press was full of enormous amount of talk. So what's missing here, right, and you know this, of course, the question is what's the unemployment rate? How do we measure the output gap? But if you listen to the press, say over the last year or two, it was all about how fast are they going to be raising rates, right? And there was this widespread impression that the Fed we're back to normal, and that's it. The Fed, market analysts were saying, oh, we're back to normal, and why aren't we getting the interest rates back to normal? That's what the hawks were saying. So buried in this little equation is exactly what do we think pi star is, what do we think the unemployment rate is. But to the market analysts, what you just heard was, we're normal, they're raising rates. You certainly didn't hear, oh, let's stay under normal for a really long time. Well, you heard it from Donald Trump. He didn't say it that way, right? But market analysts said, oh, yeah, the Fed is returning to normal because we're back to normal. Now, it's debatable about how, whether I'm right about that time consistency. That's certainly debatable. But I think it's fair to say most people were of the view that forward guidance helped. It was not the magic bullet that would be in our simple models. That's all I'd say. The other thing I was going to say, just because I know of your work on how the ZLB might not have been as binding as I've made it out to be here, That's one more reason to perhaps tie these fiscal policy things not to the federal funds rate, but to actual macro outcomes. Because we can let them decide if you were right or I was right. So if unemployment is really, really staying low, right? If it's really, really staying high, we can decide what that number is and let the numbers and let the unconventional stuff kick in those contingencies. Because it may be that short-term rate is simply not a sufficient statistic in a world where we're doing alternative creative policies. Yeah.
More questions? Just a second. You can start here and then, then we pass it to you.
Oh, okay. Thank you for a very illuminating lecture. Two questions. One is regarding the U.S. For one, they have still some arsenal when it comes to the next recession. They could buy some insurance for recessions, such as maybe lifting the target inflation, sure, or raising or lowering rates now instead of later. Yep. So there are some policies they could do now in order to, in anticipation. So it'll be interesting. And also because when it comes to the inflation targeting, I know that, for instance, Bernanke was very adamant about not changing the 2%. And I think Yellen probably was also. Powell, I don't think he's going to do it, but maybe that's some unconventional policy that they could consider. And when it comes to Japan, in 2011, they did have a recession. And even though interest rates were at the zero lower bound and all that, and they still managed, well, it's not a great recovery, but they've still managed. And Kuroda over there has done a lot more when it comes to unconventional, such as buying equities and targeting the 10-year yield to zero. And these kind of things are also things that could do also over here and in the U.S. And interesting to see what are your thoughts about implementing such policies and all that, and will they be effective?
Right. Look, I'm all in favor. I'm completely in favor of creative new monetary policy tools with two exceptions, right? I do not want to change Pi-Star. And that's not because I want a job as a central bank and I'm getting that in public. I just think it's dangerous. I have no idea how the public and markets will respond if we all of a sudden say, look, we're going to 4%, but trust us, it's going to be 4%. It's not going to be 5, it's not going to be 6, it's going to be 4, just like we thought it was 2. It's going to be 4. Maybe that'll work, maybe that won't. I don't want to roll that dice, right? The other thing I certainly don't want to do, there are limits to the stuff that I want the Fed to buy, and there are limits to what I want the ECB to buy. Some of my colleagues, like Roger Farmer, want to buy equity. In Japan, they own a bunch of the companies. That seems to me a really bad idea, right? Do we really want the Fed or the ECB to now be in charge of stock prices at any horizon? That just seems like a really bad idea. On the other stuff, I'm willing to, and it's what I told Jordy because I agree with it. He may be right that there are all these creative things. So let's tie, the debate then should be what should the automatic stabilizers, the asymmetries, what should they be tied to? Because just in case Jordy's wrong, it's possible, just in case he's wrong, I need some insurance before we have crazy things happening on the streets. And I don't see the downside, because if he's right, we'll never have to use them. If you're right, we won't have to use them. So I don't want this instead of interesting monetary policies. I want this as the relevant insurance policy.
There was a question.
Yeah, thank you for a very great talk. So you are drawing this picture of a state we are entering with really slow growth in real GDP. But it seems to me like that is primarily driven of slow growth in population. So how does it look for real GDP per capita? And what is most important in your view?
Well, that's productivity. So let's get rid. So there are some reasons to think that young economies are dynamic economies, right? There's a reason economics departments don't want to have people just my age. We like lots of young people. So there is some notion of externality associated, but let's leave that aside. That just brings us back to the productivity number. And the question is, because that's ultimately what is the crucial thing for per capita growth in a conventional view. And I really hope I'm wrong. Right? I really hope AI changes the world. I hope AI changes how I get to Heathrow without spending 6 hours yelling and screaming, or Chicago. And if that's true, that's great. But it always has to go back to, can we borrow at low interest rates to help that process? That seems to me a really critical thing, right? So anything we can do for productivity, but remember, we don't have a great track record in changing productivity growth rates. There's a reason it's called the Solow residual.
Thank you for the talk. My question is about the asymmetric impact geographically of recessions, and I'm thinking about Europe. During the crisis, the unemployment rate in Spain was above 25%, more than double the rest of Europe. How do you engineer automatic stabilizers, fiscal stabilizers in this setup? Because if you bind it to interest rates, you will decrease taxes all over Europe the same, but that will be like more expanding in a lower recession than in Spain. And if you do the opposite, if you tie it to real variables, you will be piling up debt in Spain, and in other countries you don't do that.
Let's talk. Well, so first of all, I think your point about tying it to interest rates is an excellent one. So the right solution for the United States, for various reasons, is different than Europe. So I don't see, you're slaves to ECB policy. You don't have to, on the fiscal side, you don't have to be. Now, right, so that's a great advantage of being able to do fiscal policy because you gave up the monetary policy to other people. Now, the question is whether these laws, the bond market police would go crazy if these were clearly understood as state contingent. If yes, then I don't see a problem. There's just no problem. So that's another reason to make them in law, subject to your caveat. Nothing is perfect. But the question is, bond markets will not react, I don't think, the same way to a law that says unemployment benefits go up when unemployment's over 15%. Will actually make it less likely that we'll ever get there. But I think the law and the automatic nature of in and out is crucial, especially for countries like Spain, which do have high debt. So these have to be viewed as in and out. So that will be my answer about that. It's the in and out that's absolutely crucial.
Yeah, thank you for the talk. It's a pleasure to be here. My question is, what utility do you think a country like Japan could have out of asymmetric, automatic, although the word automatic, I think, is debatable for Japan because they've always been in the state where they need this. Given that they don't have unemployment beyond usual and the debt is already beyond imagination to, I think, even have VAT cuts because, God forsake, if you go wrong, then the debt could explode even more. So
first, let me remind you, I said that anything about Japan is hard. But two things about Japan. The debt is not nearly as bad as you think because the 240% numbers that you see are gross debt. When you net it out, they're not all that different from Western Europe. So that, just as a factual matter, be careful about how you look at those debt numbers. They're not nearly as bad as you think. The other thing is Japan has low taxes, and that's one reason bond markets think they can always raise taxes. They don't have a lot of problems doing that. The third thing, and this goes back to the other gentleman's point, is per capita growth in Japan has not been particularly bad. It's a little worse than the US, but not much. So Japan's not as different as we like to think. So I don't see a particular reason why you couldn't do this in Japan. There remains an issue of what you would tie it to. And there I would ask any political scientists to get involved in the debate, because that really is not just about economics, it's also about politics.
Raul?
Hi. Thanks a lot for the talk, Marty. I was going to ask a question very much related to Hugo's. So just adding on it then, in terms of Europe, so do you really think this could work in Europe? I mean, thinking about the political fiscal policy as an insurance. I mean, capital can move across countries, people can move across countries. Don't you think like countries are going to start to compete also in the form of taxation that they have?
So
should we think about the fiscal union as well, as opposed to having the discretion?
No, I think you guys have way too much union. The last thing you need is more union. That's my opinion. So I'm not an expert on Europe, although I love coming here. Sergio Rebello and I did the internal review of the IMF's program in Portugal. And of Portugal, we didn't do the Greece or Ireland, we did the Portugal part. So that's, and the one thing that was absolutely clear was multipliers were far bigger than the IMF thought. And if you actually look at their forecast errors for real GDP, and everybody knows those are way off, you can explain almost all of it by the multiplier. They just screwed up. So multipliers are real just as much here as anywhere else, maybe more so. Then the question is, can this society credibly commit to in and out? You know much more about Spanish politics. The good news is that's something you get to decide. You don't have to coordinate with anyone else. That's a Spanish problem. I know I'm in so I'm going to just use Spain, sorry. That is a problem for this country, however as you define it. Okay? And I don't see any particular reason for bond markets to go crazy if this is an in and out. Remember, the alternative is very bad, potentially. The alternative is very bad. You have unemployment benefits, so we're not asking for new, I'm not advocating new program. In the United States, it's a little more complicated. So for example, we don't have a VAT, we don't have a sales tax at the national level, but states do. So what various people have advocated, like Alan Winders has advocated, that they can't incur debt. Right? States can't incur a lot of debt. So if they got rid of the sales tax, right, how would they make up for it? Blinder's whole point is that's exactly when the federal government ought to borrow to make up that revenue in the form of grants. And it would come off exactly when the targets came off. So one can be creative about these things, and the institutional details will matter. So I completely agree with that. But again, I say the law is very helpful. It's not a bullet for everything, but the force of law matters.
Any other question? We can.
Should we put it to a vote? No.
Well, anyway.
I would say. So I mean, during the Great Recession in many European countries, the opposite happened, right? They all raised VAT quite a lot, actually. And so what could go wrong is that if you do the opposite, like you're suggesting, the signaling between whether a country is going to default or not gets even more confounded, no? Because there's huge deficits. There was a huge deficit here in 2009. And investors in Kazakhstan or whatever, all they saw was, 11% deficit. No? if on top of that you make it 13%.
Sure. So I think that's why you can't do it in the crisis. If you decide, once you're in the crisis, and then you say, trust me from now on, that's clearly not going to work. Right? I think we can all agree on that. But now is the time to do it when you're not in a crisis. Let the markets get used to it. Eventually they'll forget about it. No one talks about unemployment benefits in the United States. They happen. We don't vote on, for example, whether California, if they're in a recession, that they should get more unemployment benefits. They just do, and no one really cares, and no one knows, frankly. If you do it up front in good times, then it just happens. Policy changes in the middle of a crisis are not the way to go. It's like I remember in the Argentinian crisis when the Argentinians finally noticed in the old regime that when they were dollarized, that they shouldn't be dollarized, they should be tied to something else, Mercosur or something. Well, in the middle of the crisis is not the time to make that change. So that would be the analog answer.
Well, good. I think we can say.
Yeah, we can maybe continue the discussion next door in the foyer.
Fantastic.
Thank you.